Hello and welcome back to Katie's Business Tips. Michael Lapede here giving you some nuggets on trusts. And we're particularly mostly talking about family trusts here, but there's tons of other trusts. Alter ego trusts, spousal trusts, mutual fund trusts. I mean, there is so many different types of trusts. But a lot of times when we set up trusts for business owners and people with forms of wealth that they're growing and want to pass on to the next generation, that's typically a family trust. And that is a type of inter vivos trust, as we talked about. One of the other things you got to remember is you can either create a discretionary trust or an indiscretionary trust. Discretionary means the trustee or trustees have discretion on how they're going to run it and how they're going to distribute to the beneficiaries. A non-discretionary trust lays out the parameter in the trust deed as to how it's going to go. So if you have 3 beneficiaries, you're going to say, well, every year you're going to benefit, you're going to divvy it up by 3, as an example. And the trustee can't do nothing. He's bound by that trust. That's non-discretionary. But if we want to give the trustee discretion, he or she can control what is distributed from the trust. So that discretionary and non-discretionary is very important. Now, there's a lot of benefits of having trust and some drawbacks, and that's what we're going to use this video for. We're going to talk about some of the benefits and some of the drawbacks of having a family trust. Now, the benefits, first of all, is that we want to use it for income splitting. Trusts are meant to flow through income to beneficiaries. Dividends, capital gains, business income, investment income, whatever it is, it's going to come into the trust and then going to flow through a lot of times to the beneficiaries. That could be individuals, could be family members, could be corporations, could be other trusts even. You know, whoever those beneficiaries are going to receive that form of income and is going to retain the same characteristic. If it goes in as a dividend to the trust, it's going to come out to the beneficiary as a dividend. So we are going to use the trust, therefore, for income splitting, splitting dividends, splitting capital gains. That's huge because a lot of times you can't split the capital gains after the fact, but in a trust you can. So if the trust ends up with capital gains income, it can split it out to the beneficiaries. Very nice, especially if one of the beneficiaries has a loss carry forward, like we talked about in a prior video. Maybe they have capital loss carry forward. They can use it up, right? So we want to split that income. We're allowed to do that. So it's one of the big benefits of the trust is flowing through income and splitting it as it flows out. Okay. We can also multiply the capital gains exemption. So if, for example, the trust owns your business shares and you sell your business for a lot of money, your shares for a lot of money, and they qualify for the capital gains exemption, each individual that's a beneficiary of the trust has about $1 million capital gains exemption. So before you know, it's $1 million tax-free, $1 million tax-free. How many people you got in your trust, right? How many millions could you sell your business for and use their capital gains exemptions? Your kids, your aunts, your uncles, your parents. Now remember, once they use it, they can't use it again. So once it's used for life. So you're going to have to compensate them maybe potentially, or if they say, I'm never going to use it and they're getting older, well, who cares then, right? So at the end of the day, you want to multiply that capital gains exemption because you could sell your company for millions of dollars tax-free. Another benefit is you can multiply the small business deduction, which we talked about the small business deduction in a prior video series. And we can multiply that by setting up multiple trusts and separate ownerships and not having any cross ownerships. And we can have each of the corporations, therefore, have separate small business deductions because normally they're associated when it's the same ownership and they share the small business deduction. We can also pass assets tax-free upon death. So the trust stays living, so maybe we don't even need to pass that. Maybe they just take control of the assets, for example, because the trust stays living. And the last one here is creditor protection, right? Liability protection. So we're looking at estate planning, passing things on to the next generation. We're looking at tax planning, like we talked about, splitting income, splitting capital gains, exemption, etc. And we're also looking at liability protection. All 3 of them are available inside a trust. Now, what about the disadvantages, right? There's obviously disadvantages too. Well, there's 2. Number 1, they can be expensive to set up. You're looking at minimum $5,000 set up, plus if you got to roll things in, it's thousands of more dollars, right? It's one time. Then there's going to be some annual fees, maybe $1,000 a year, whatever, to take care of the trust. And on top of that is, there's extra layers now to do things. So if you're transferring money, you might have to transfer to an extra account. So there's more complexities that come with a trust. And if you wait too long, it can get even more complex. So you don't want to build a big empire and then set up your trust either. Now, there's a lot of other rules like the 21-year deed and disposition rule, all these things. This get very complicated. So you're better off to sit down with a professional like us. We can talk about it, but this gives you enough nuggets to understand. And if you've got any questions, just post below and we'll answer them. Thanks for being a part of our business tips, and we'll see you in the next video.